healthcare, hospital services, pharmaceutical manufacturing companies, specialty chemicals, a basket of these. These are the kind of companies that are there in this segment. And I think more and more service-led companies or services companies will kind of try to access this market to be able to grow, maybe domestically as well as internationally, professionalize, get shareholders who will kind of rally for this company. So a lot of exciting stuff is going to happen.
Hello everyone and welcome to Market Pillars Uncovered. I'm Avan Dabash. Here's where we really uncover the engines behind India's financial transformation. Today we have with us a special guest. We have Mr. Abhishek Banerjee, who is the founder and CEO of Lotusdew, a pioneer in AI-driven and AI-led investing in India with a special focus on SME Gems. His work actually sits at a very interesting intersection of investor behavior, AI-led finance, as well as long-term wealth creation. On today's episode, we will put the spotlight on SME investing opportunities, how Lotusdew is decoding investor behavior, what the outlook is on AI investing, and how you can as well create your own microscope and identify SME opportunities early. So let's get started. Thank you so much for taking time out and joining in. So I just wanted to start with what problem you believe Lotusdew is really identifying. What were the existing models not picking up that you believe that intervention of Lotusdew was required? And if you could tell us a little bit about your background as well.
Sure. So, I started my investing career with NN Partners. Now it's acquired by Goldman Sachs. And then subsequently I worked for a sovereign fund managing sovereign money. And then for a hedge fund called Alpha Parity under the aegis of Franklin Templeton International. Across these experiences, one of the things that I encountered when I was working for the sovereign fund was that I could meet a lot of fund managers who would run money in different ways. And they were all extremely smart people, but they were all often wrong. So what I kind of realized, and I was very young then, is that it is not really how smart you are that makes a difference in the market, but it's more like how you perceive, how observant you are. Okay. And one of the things that I figured was that, of course, we try to observe value from looking at macro data, looking at balance sheets, but there is also a way to measure conviction by looking at what people do with their money. And when I was working for the sovereign fund, one of the things that I learned very deeply is that where do you get regulatory disclosures of institutions and where they disclose how are they positioned with their money. And you can get that from many countries and many institutions. And the idea popped in my head is, why can't I take this data where I can measure change in conviction globally and use that as a way to complement how we screen for stocks in India. And that's how basically Lotusdew was born. And when I look back, I think, all my life, I always wanted to set up my own, shop in India. And every relation and every opportunity I had to work with an institution or somebody else, I was kind of working towards it for this eventuality. And that's the way I put it. But broadly what we do is in AI, you can measure these changes in conviction, looking at the holdings of institutions across the world and juxtapose it or kind of compare it with how they behave with their money. So for example, if somebody is getting an inflow in their fund, are they buying the laggards or are they buying the ones that have made most money, and how have those bets fared in the past, and how have they changed their position when these kind of bets have played out? And you can measure it in aggregate. So we track close to 8,000 investors globally through AI and data analysis, and we are able to kind of very clearly see from a long-term investing standpoint, how do people behave with their money when they're actually putting their money to work. And that's kind of that's what we really do. And the second thing we discovered is that yes, balance sheet is a great place to find value for companies, but sometimes the value is created before even if it shows up in the balance sheet subsequently, right? And one of the things we discovered is that in India, there are close to 3,000 companies that are less than 1,000 crore in market cap that nobody bothers about, right? Everybody is looking at the top 700 stocks because it's very hard. It's really hard to do. I mean, if you imagine a setup where you have like 5 analysts looking at 3,000 companies, 500 companies each analyst, they're going through 2-3 companies a day. Their 250 business days, it's an intractable problem. By the time they cover the universe, they're back to square one because 1 year would have passed. So either you need a lot of people, which means that you need to kind of fund that operation, and therefore you need a very large fund, which cannot be deployed because the market cap of these companies are pretty small. So there is a gap in the market where investor behavior coupled with microcap based on corporate governance is a way we saw as a kind of position where there was hardly any solution available for Indian investors, and that's kind of what we focused on. So we focus on AI-led investor behavior analysis coupled with corporate governance screening for really small companies.
Okay. It's quite interesting there because you talk about the importance of behavioral finance, and I think that has a big part to play as well. So with this kind of in-depth knowledge, the fact that you've unearthed a lot of focus on SMEs, how big is this opportunity? How promising is it for SMEs, for a retail investor?
It's going to be a opportunity of a generation, really. Because, I'll give you the stats, right? So there are about 5 crores SMEs that exist in India, and the growth rate of SMEs by far above GDP, right? Second point is that if there's a lot of reports that you can see where you can see that about 5 lakh of these SMEs have the balance sheet that it would take to kind of get listed. Obviously, most won't list because of many other reasons. But even let's say 1 or 2% of this universe list, while this universe is growing, I think in the next 10 years we'll have more companies listed in the SME segment than we would have in NSE and BSE combined. So it's going to be probably 10,000 companies listed on this exchange, and it's just humanly not possible to track 10,000 companies through fundamental way of analysis, and therefore it really presents an opportunity where if there is a way to kind of uncover these hidden gems as they come through, as well as find long-term investing opportunities about these really capital hungry companies that have traditionally been served by mid-market, private market, and now they can kind of get access to public money, which is almost like a UPI moment for mid-market.
Okay, so you're really calling this a huge opportunity. So given all of your observations that you've gone through, the fact that you're saying that it's going to be a golden opportunity, the era for these SME companies, if you could identify or nail it down to 3 sectors within the space that you think look promising, which would they be?
So I think, it's very clear. Capital goods, services and pharmaceuticals, these actually comprise of the maximum in terms of sector weights in the current SME listed companies. And it's very clear, right? Services companies usually do not have assets that they can use to kind of borrow. So they are kind of capital constrained unless they can find external capital. Many of these companies will do really well in terms of growth, but they're not VC kind of models where, it's hyper scalable. So there is a gap, right? You have these really, hyper scaled companies which VCs like, and you have these really stable companies that banks like in terms of bank loans. But in the middle, that's the mid-market, there is literally, as we stand today, there's probably, a little bit of private equity that plays in, and mostly it's, promoters pledging their personal assets to kind of borrow and fund this company, or it's going to be some external partner who joins the business, and it's often a reason for conflict. So there is need for such capital in the sectors like capital goods, right, where you can have fixed capital formation through investing. Most of these listed companies come from capital goods and manufacturing, maybe textiles. A little bit of it is in services, about 17-18%, and 17-18% in healthcare. By the way, even in the big indices, healthcare is not such a big part of the market, and this market, healthcare is a pretty large part. And we all know healthcare is going to be super important.
So you think that's going to be one of the booming sectors?
So I think healthcare, hospital services, pharmaceutical manufacturing companies, specialty chemicals, a basket of these. These are the kind of companies that are there in this segment, and I think more and more service-led companies or services companies will kind of try to access this market to be able to grow maybe domestically as well as internationally, professionalize, get shareholders who will kind of rally for this company. So a lot of exciting stuff is going to happen.
So given that you're leveraging AI, you're using behavioral patterns, which are the 3 SMEs that you identified, the gems that you identified before the market or ahead of the market?
So we found a company that's listed in the SME segment that exclusively works on visual effects for Hollywood studios.
Okay.
Right? So it's a service company. It's a company that basically has export revenues, but it's recession proof, because we all know that when markets are not doing well in terms of economy, people consume more entertainment, right? So if they're working on entertainment, it's kind of a service which is recession proof, which is kind of antithesis of most of the IT services companies that are listed, because the major market for them is banking and financial services, and in a recessionary environment, they kind of do not do really well. So we found this company. We also found companies that basically manufacture nitrates, which is, they are a dominant player in nitrates and they're listed. We found companies that are, healthcare services provider, a hospital that is, doing really well. That's a great prospect ahead. So there are these tiny companies that we found, but, they're very interesting opportunities on their own. You wouldn't find any other company in any other segment of the market which works on visual effects, for example, or has a gaming future. So these kind of companies are available in the SME segment, which are not generally available in the main board.
Okay, hence they're called hidden gems, I guess. Yeah. So I'm sure there must be something more to it, that what is helping in identifying some of these great opportunities, these multiplier level returns. Can you just share a little bit more about what those insights are, the secret to spotting them?
Yeah, so there is, the main thing about identifying companies is that, you work with secondary data, which means the data that is given out by companies. The challenge for analysts is that how well do you trust this data, because there have been many instances of fraud by listed companies. So these are really small companies, so it's very hard to, the auditors might not be auditing any other company. It's just one auditor who audits this particular company which is listed. So the data that you're getting, you have to be really circumspect about the data that you see, even though it's kind of verified and audited. One of the things we have learned is that people are okay to lose money, but people are very, very reluctant to lose reputation, right? So what we really want to track is how reputable is the board, right? How well are these people who are on the board linked to these companies professionally? What kind of reputation do they bring to the board, and how much reputation do they stake in terms of losing should they associate with the wrong kind of company? And that has served to be a great signal as a way to identify something interesting about these companies, because what you see is that there are great professionals who are sitting on the boards of really high quality companies, but also on the boards of these really tiny companies, and you stop and think, why would they do that? It's only because board members, as insiders of the company, they see prospects that minority shareholders who are looking at the secondary market cannot see. So you have to understand that either if it's not for a family reason or it's not excessive board sitting fee, the only reason they would do this is that they see something extremely high value in that company where they're willing to take that risk on their own reputation to be part of this small company. And that's been a great signal. That's been a way to identify these hidden gems, because now you can start looking at these companies, right? What is that this person sees that we don't see yet?
Yeah.
And that has been the key trigger. Next is that these have to be consistent, which means it's very hard to be consistent in anything that you do. And it's even more hard to be consistent with business. But businesses which achieve consistency, be it in the form of operating margins, be it in the form of tax payments, where tax payments are not varying a lot, because that signifies business model changes, or being consistent with operating margins. It's very hard to do it in a business, and if you're consistent and able to do that, and because you're listed, we can measure that. That has served to be a second best way of identifying, they are good businesses. And third, and the most important that we look for, is a way to find what we call micro monopolies, right? So these are small companies, often very small. They operate in a market which also is small, but they are like the biggest in that market. So they're biggest in a niche, and they are consistent, and they're run by high quality, trustable boards. So that's kind of the secret sauce.
Okay, that's the criteria. But on the flip side, what would be the red flags that would stop you from spending time or even money on a company?
One thing we have learned is, what we do with AI also is we look at the tax litigation history. For example, we look at how these companies have been paying taxes, be it in numbers, be it in tax litigation they are into. There's one thing called tax planning and there's another thing called tax avoidance, right? So what we want to glean from that is, are they trying to be tax smart or tax non-compliant? And if there is a problem there, I think that's really a red flag, because tax authorities are very detailed and often they catch the right thing, right? So we think that's a big red flag of when we analyze that. So we have connections with databases that have past case history, and we try to estimate, like, given this is the language, of course, with these kind of text-based AI models, what is the likely outcome and how have those cases fared? It's not really about we are trying to predict what the case is going to be. It's more about what kind of incidence is this, right? And is this a planning incidence or a sort of avoidance incidence? That's been a great indicator. Second thing we focus a lot on is change in the board. So if there's turnover at the top, things are not good, right? So that has always been the right way of looking at companies. I know it's a ship. There are a lot of things which are uncertain. One thing you should be certain about is your team, right? Because they are going to kind of be running this, piloting this ship. So if there's turnover at the board level, or there's turnover in the management, that's usually a bad signal. And we look at that very carefully sometimes. Often we reject companies just because of that. And then finally, of course, the most important thing is, are they growing and consistent, right? Are they struggling, right? We are not interested in turnaround stories or special situations. That's a different style of investing. We don't do that. But these for us are the really three main red flags, and we don't go ahead with companies which produce these.
Good to know. So once a company has actually passed that criteria, they are not on the red flag list. How does one go about this SME research? Typically, how long does it take, whether one is investing in IPO or pre-listing?
Yeah, so I mean,
post-listing, right?
Post-listing, yeah. I mean, pre-listing, IPO, there are a couple of, ways. Let's say there was a particular way of accessing QIB quota through AIFs, where you could be part of an AIF and access QIB quota, get pre-listing gains. IPO pop, as it's called famously, it's difficult to kind of get these companies before IPO and then always expect a return. The main reason is that you behave differently in a private market and you got to behave differently in a public market setup, right? And many companies find this a challenge where they have been thriving and successful raising money in private markets. Suddenly it becomes difficult for them to anticipate what the public market expects from them, right? And this situation often creates problems. So it's always better because you have so many choices, right? There are 3,000-4,000 companies. It's not necessary to go after the companies which do not have a track record. We always prefer companies that have a track record in the public market to see how they have fared, right? And that has kind of been the case for us.
So for someone who doesn't have the time to really devote to this detailed, in-depth research, can they really benefit from the SME opportunity, and if so, how?
Yeah, so I think this requires a lot of research, and by the way, the SME market, the stocks do not trade in single quantity; they trade in lots, like futures do, which means that you got to invest at least 1 or 2 lakh per share before you can take exposure, and often these are very liquid. It's a kind of different market where there's a dedicated market maker for the stock, and they're required to provide two-way quotes 70% of the time for the first 3 years after listing. So that means that you are guaranteed liquidity in a certain sense, but you could also have a bid-ask spread as big as 20%. So if you buy the company and sell it immediately, you immediately lose 20%. So it's a very treacherous market. Without research, it's going to be really, really tough to get it right. We do recommend professional products. I mean, it's definitely not something casual research can do.
Absolutely.
Also, there are no sell-side research reports. So if you go on different websites where some broker houses or some research providers do publish public reports on companies, you'll never find any of these companies there. So which means that you have to do all the groundwork yourself, right? And professional research is, what I would recommend.
Absolutely, because treacherous, as you said.
It's very treacherous. It's, you could easily lose money.
Absolutely.
In fact, we did an analysis where 43% of the companies actually lost money post IPO. So, you're likely to lose, 50% of the time you're likely to lose money. if you have invested in these IPOs.
Yeah.
So while IPO is a great way to get that pop, but 50% chance that you could be wrong.
Absolutely, and get your fingers burnt.
Yeah.
What about AIFs? Because that is an interesting option, but what are the checks and balances that one needs to put in place before investing via this route?
Yeah, AIFs are a great vehicle for this kind of stuff. There's AIF category 1. There is a special carve out for SMEs. However, the challenge is that even though there is a carve out, the market is not that big yet, where you can have an AIF which is purely focused on SME, which means that for a professional fund manager, unless they're able to deploy at least 50 crores in a market, the market just doesn't exist, right? So the SME market that we see and the number of companies that are there, the good ones, they can hardly absorb any amount of capital close to that. So there's category 1, there's no product there. There is, of course, other categories of AIF, let's say, where people are pooling in money to invest pre-IPO and then hold it for 180 days post-IPO and try to earn a return there. There are PMSs which offer products which have some exposure to SME. But it's really, when I look at this market, it reminds me of how the markets were back in 1980s, right? Where you had only one managed product like UTI, and there were literally no mutual funds. It was a brokered access, a broker bana ke deta tha, that was the...
Yeah. And what about behavioral alpha? Because you've spoken about that versus just price momentum.
Yeah.
What is the importance?
See, behavioral alpha is quite important when you're trying to understand the global trends.
Okay.
What I explained, right? When we track this investor behavior of 8,000 investors, what we find is that different professional investors behave differently with behavioral biases like anchoring, loss aversion, looking at things like basically recency bias. All these, actually, everybody is human. They do get impacted and influenced by these kind of biases. Even I do. But it's how you behave with these biases with the money which really drives how you are as a institution or a portfolio manager. And if you can measure this across time and then aggregate this across different people, though this data is delayed, often delayed by 60 days. So what you lose in terms of immediacy of the data, you get back much more in terms of robustness, because it's not just me thinking that I can outsmart the market. It's basically I'm measuring a lot of people who are supposed to be professionals in the market and not crowd intelligence, right? So we are not measuring momentum, we are not measuring what the general market is doing. We are basically measuring how professionals trained in the market are behaving with their money, and use that signal to build bottom up where their dominant conviction lies. So it's really more about how they see the global macro from their positioning. It's more about how they essentially move the money in terms of inflow or outflow relative to these kind of biases.
Yeah.
So we are able to measure that through a lot of software that we have built, and that allows us to really tease this out.
Absolutely. So when your days are not filled with AI and software and decoding SME trends, what is it that keeps you busy?
I really don't have any other hobby than markets.
Really?
Yes.
So that's your passion.
That's
good to know. And I think that clearly is reflecting in what you've built. So thank you so much for joining in. You've really opened our eyes to this huge SME opportunity that, as you said, is a big one that's going to explode in the next few years. And thank you for walking us through all of the details on behavioral aspects for consumers, as well as how technology plays a big role.
It's been a pleasure to interact with you, and thanks for all the great questions.
Of course. So that brings us to the end of this episode. I hope you certainly had your eyes open to the SME opportunity, but do remember there was a huge caveat that the professionals really know how to do it. It would be a very dangerous opportunity, and you can get your fingers burnt and your hard-earned money lost if you don't exploit that. I hope you enjoyed watching the episode. Do remember to subscribe to Money TV, and thank you so much for tuning in.